So as I was just describing, the goal of this is to make it easier for people to learn about the fundraising environment, learn about the fundraising ecosystem, and save you a lot of pain and suffering, because otherwise you can waste a whole lot of time trying to figure these things out and not gather these conclusions. So as a result, we have Fundraising for Founders, Escape from Clowntown. The goal of this presentation is to save founders time. As a founder, time is the only thing you have, and when you waste your time, it's terrible. It's very easy to waste your time talking to the wrong types of investors or signing up investors who end up being the wrong kinds of people. The first thing is, let's assume you don't know any investors. You've zero connection to the world of capital, you've no context. You've started a company, you want to find investors. First question is like, where do you meet these people? Because you can do cold outreach, you can send them emails, but really, if you don't know anyone and you have no context, the best thing is to meet them in person at events. If you don't like traveling, get out of this business. You've got to travel to events. It's simple as that. There are two main event platforms that you need to understand and use, Luma and Partful. Meetup and Eventbrite, it's sort of the old-timey events platforms. You don't really use those, and no one who's serious about this engages with those anymore. This will change in another 5 years. There will be some new event platform, which is the new cool one, but for now, it's these two. Those are the ones that matter. The second thing is how to conduct yourself at these events. A lot of people show up to events and they're just trying to pitch, and they've got some idea of what they're going to say. The reality is that when you're at these events, the number one rule is just be cool. Be a cool person to talk to. No one wants to talk to someone that's stressed out. No one wants to talk to someone who exudes desperation. You need to be a cool person to talk to. And you are, because you're a founder working on an interesting thing. So embrace that and be a cool person to talk to. Within this, have a conversation. You know, don't show up and say, here's my pitch, then pitch. Just say, oh, hey, how's it going? And have a conversation with them. Notice something about them. Engage them in conversation. This is normal stuff, but is often lost on people who are trying to raise money. The third thing is asking the specific relevant questions, because depending on what questions you ask, you will be judged. If they're a serious individual, they know they're looking for people that are asking certain questions, and we'll get into the types of questions that you want to ask the different types of people after each section of people. All right, so it's a little hard to read, but this is kind of the grand scale of all fundraising. At the top, you've got Elysium. This is the properly super rich people. These 5 billion plus net worth families are not on the Forbes list. They do not go to events. You will not talk to them. They are the limited partners who provide money to the tier 1 and tier 2 institutional funds of the world. So if you are a properly rich family and you want to have exposure to private markets, you do that by giving Andreessen Horowitz $200 million, or by investing in Kleiner Perkins' fund with $100 million, whatever the number is. But the point is that they don't engage directly with startups almost ever. They only engage with the world of institutional capital. Institutional capital breaks down into 3 sections. You've got the tier 1 funds, and we'll get into each of these sections. You've got the tier 2 funds, the tier 3 funds, and within the tier 3 funds, the primary thing is emerging managers. We'll discuss the structure of that in a moment. Then you have $100 million plus net worth family offices. Family offices are probably the most interesting category of investor right now for the majority of startups that exist in the Vegas ecosystem and exist in a lot of other ecosystems around the country. Historically speaking, these family offices also wrote checks into the institutional capital groups, but in the last few years, institutional capital returns have been quite bad. So between 2017, 18, and 19, funds that raised money during that period, they allocated a lot of funds during a period of years in which valuations were dramatically inflated. So 2020, 2021, 2022, and when you're a fund that raises money, you're doing that for a 10-year cycle, and you need to allocate your funds within the first 5 years of your fund. So you raise $100 million, you need to invest all $100 million of that in the first 5 years in order for you to have any reasonable chance of getting a return on your investment and returning the fund, because startups take a long time to grow and then be acquired and then get returns for their funds, right? Unfortunately, what that means is people that raised and started funds in 2017, 18, 19 ended up with a very bad portfolio performance on the whole, which drove a ton of family offices into the world of direct investment. Because if the so-called experts at the institutional capital firms are fucking up my money, I might as well be the one fucking up my money, right? At the bottom, we have individuals who are $5 million plus net worth. This is the world of Clowntown, and unfortunately, a lot of the world of angel investors, as they call themselves. So we'll start off at the bottom. What is Clowntown? Clowntown is people who have some money and they hear about startups and how much money they can make by doing it. Oh my gosh, you hear about the guy that invested in Uber right off the bat. He made $1 billion off of 100,000. Oh, isn't that a great story? It is a great story. But the reality is that accessing those deals and working in that way is not accessible to your average doctor, lawyer, VP at a company, the types of people that have a few $1 million in the bank and they've got a decent stock portfolio, but they think they're going to start investing in the world of startups. These people, by and large, don't know that they're clowns, and that's the biggest problem. They'll show up and talk to you as though they're a real serious individual, and if you're a first-time founder and you don't know about the whole grand structure of this, it's very easy to believe someone introduces themselves. I'm an investor. Wow, great. What do you invest in? I invest in this. Oh gosh. They're clowns. They will waste your time in so many ways. Don't deal with them. Ways to check if you are in Clowntown and talking to someone who lives there. The first most important qualifying question is, if you lost $100,000 right now, would your day be ruined? Is this a bad day for you? If yes, you're in Clowntown. Yeah, it's as simple as that. If you're worried about losing 100K, you need to be investing in the S&P 500, not startups. Simple as that. Other qualifying questions that you can ask are, tell me about your recent investments, right? Pretty straightforward. And they can tell you about companies they've invested in, and if they don't have a really strong list of very strong companies in which they've been involved, that's a pretty immediate filter that you can avoid. And the last question is, how often do you talk to your founders? One of the problems with these early stage sort of Clowntown investors is that even if you work with them and take their money, they're the most likely people to be bothering you about it. They'll call you every couple of weeks. Like, how's it going? Oh, what's happening here? You don't have time for that. Because over the course of raising money across the multiple stages of your company as you scale it, you're going to end up with like 20, 30 groups of people who have an interest in you. And if every single one of those groups of people is trying to contact you and ask you questions about how things are going every couple of weeks, you're going to end up spending like 30, 40% of your time just dealing with that. So the answer that you should seek for each of these questions is like, no, that would not stress me out at all. That's like trivial money, no big deal. They should be able to speak to strong recent investments and talk in detail about those companies, because if they're directly investing, they should have direct exposure to the founder and actually be able to speak intelligently on it. Not like, oh, it's some cool blockchain thing. Like, no, like exactly what does this do and why, and they should know that. And then how often do you talk to your founders? At most like once a quarter, but ideally it's when they call me. Because if you've got good investors, you do want to talk to them. They have relevance for your industry, they've got useful connections to offer you, so you contact them, they don't contact you. So the next tier, as we go up the pyramid, is sort of the useful territory. This is the world of $100 million plus net worth family offices. And the key term is family offices, right? That's what they call it. You're a rich enough family that you have employees or a member of the family, usually like the younger generation who thinks venture is interesting and cool, and they want to get involved with startups directly. Their check sizes are worthwhile. These checks range from 100 to 500K. Some families do even more than that. But the point is that if you're raising like $1 million or $2 million pre-seed or like a $3 to $5 million seed round, think about how many of these checks you have to stack up to get to the end of that round. Assume each conversation takes like 6 weeks or so. And yeah, you can overlap them at the earliest stage sometimes, but sometimes you can't. And so as a result, point is, if you're trying to raise $1 million on $20,000 checks, you're never going to get there. You need people who are qualified at a certain level so that you can manage your time appropriately. And again, it's generally, in most cases, a member of the family. The world of the family offices that exist at the very top of the pyramid, those $1 billion+ people, they have like robust employees. They have like a family office with 6 people that work for just that office allocating that investment. But at this tier, it's usually an individual member of the family who is directly allocating. So questions that can help you determine if they are useful. Again, like if they are serious or not. Very simple, what's typical check size and what valuations do you target? Usually family offices will have some sort of charter or structure they've agreed to internally, and again, they should be able to say, yeah, our sweet spot is 200 to 350K, and we target valuations at $6 to $10 million. This is very useful for you, because if you're raising at a $15 million valuation, you know you can move on from that conversation right now. You are outside of the range. A broader theme with investment conversations is don't try to get them to do something which is outside of the range in which they exist. It is a waste of your time. You are playing the numbers game. You need to connect with and find the right people. So if someone says their max check size is 300 and your minimum check size is 400, don't talk to them. Move on to the next person at the event. Just keep it rolling. Do you invest in safe rounds or price rounds? So safe rounds are usually the structure that you're going to use for the pre-seed and seed rounds. Sometimes you will do a price round for a seed round. Generally speaking, anything after seed will always be a price round unless there's some really strange circumstance that enables you to use safe rounds after that. But this is a useful qualifying question because it will tell you what stage they invest at. When you're talking to someone who says they're from a family office, it's very possible that they're a family office that's doing growth stage investments with a minimum check size of $10 million. And again, if you're trying to raise $1 million seed round, don't talk to them. Just because the number that you're trying to raise is lower than the number that they say they have to allocate does not mean that they're going to slice off a small piece for you. It's actually the opposite. If they're trying to allocate checks between $20 and $50 million, it's because they're trying to get a return on a fund which is $300 to $500 million. And just like you, the founder, who is trying to raise your $1 million round, then you can't take a $20,000 check because it's going to take you forever to get there. If you're trying to get a return on a $200 to $500 million fund, you as the allocator simply cannot write $1 million checks, because what are you going to do? You're going to write 150 checks? That's insane. There's just too many conversations, not possible. And then again, the question of how often do you talk to founders in your portfolio? This one is worded slightly differently because you're trying to get at portfolio here, right? If they're a family office that's serious, they're going to have a portfolio of investments, and you're not going to say when you talk to your founders, you're going to say when you talk to founders in your portfolio. And again, the same answer is valid here, like once a quarter or ideally when they call me. So now that we're through family offices, which again I stress, family offices are an excellent source of funding because they don't have the same financial requirements that VCs do, especially if it's their own money. We move into the world of institutional funds. So folks that say, oh, I'm the general partner at a VC fund, and you look up the VC fund and they've got one general partner. Okay, odds are high that this is an emerging manager, meaning that they are running a fund and they have, for the first time, raised a fund from LPs to allocate. VC funds take money from the properly rich people and then invest that for them, right? They usually will have $25 to $100 million of assets under management, and because it's their first fund and they can't raise money from LPs on their track record of being an insanely good investor over the course of the last 30 years, like they're not a famous person like John Doe or whatever, they have to be very specific and thesis driven. They have to say, I am a good investor because I spent 30 years in X industry, I have unique insights about X industry, and I have deal flow and exposure to founders in X industry. So as a result, their thesis will be very specific to a certain narrative. And again, if you're on the narrative with them and you're raising a fund that fits within their check sizes, which again will range from usually like 500 to $1.5 million if their fund is $25 to $100 million, then you've got some good indicators that this is a worthwhile conversation. An example of an emerging fund would be Omni Venture Labs. I'm an advisor for them just because my friend started it. But the point is that it's run by 3 people who have been focused on manufacturing automation, specifically software that automates manufacturing processes. So it's like, okay, are you software that helps people design products? No, we don't care. Are you hardware that is going to be made on these machines? Nope, we don't care. Are you software which helps optimize the movement of robotic arms inside of fully automated assembly facilities? Yes, absolutely, correct. And so when you're on narrative with these people, that's the key. Like, again, respect the specificity of their narrative and move on if you don't fit within that, dive deeper if you do. Questions to ask people to see if you're on narrative and also just to qualify them. Because one point about emerging managers, there are a lot of people who will say, oh, I run a VC fund, and they've got a little website where it says they run a VC fund. But they may still be raising their fund, which means they don't actually have any money. People will say, oh yeah, I'm the general partner at this fund, which is true, they started the fund and they're the general partner there, but until they've done their first capital call with their LPs, they don't actually have any money to write checks out of. So these are important questions to ask. Which fund are you on? What's your AUM? If they lie about their AUM and say I've got X many assets under management and they don't, bad people, right? But the point is that those 2 questions will tell you. They should say I'm on fund 1 and my AUM is $25 million. Or if they haven't done a capital call, they should say I'm on fund 1 and we're doing our capital call in June and we're expecting to pull in $10 to $20 million out of that. Those are the types of answers that you're looking for. Then you get into like founder profile. So So narrative matters in the sense of what you're working on, but it also matters in the sense of who you are and the other members of your founding team. Again, funds will say, we are a manufacturing technology fund that's focused on software that automates processes, and you ask, okay, what's your ideal founder profile? They'll say, okay, it's a person who just graduated from Stanford in this, or it's a person who's got 20 years of experience here, and they've got insights about that. They should have a very specific answer for this. And again, if you are not that thing, exit the conversation and move on elsewhere, because you're wasting their time and they're wasting your time. What is your lead versus follow breakdown? So for funds that have existed for a long time, it's very easy to see this. You can just dig that up in terms of data that's online, Crunchbase and PitchBook and stuff like that. For a new fund, it's not clear always whether they're a fund that does lead investments or follows. Most emerging managers try to do follow-on investment, but this is very challenging to do as an emerging manager because in order to get follow-on slots, you've got to already have a really strong network of founders that want to give you those. As a founder, it's very tricky to get a lead investor. It's pretty trivial to get follow-on investment. So the game theory kind of works out that unless you are leading, you are not going to get deals as an emerging manager. So some people will say we are leading always, and that's how they get deals. Some people will rely on their network to get those following spots, but this matters for you in terms of how you structure your round, and it's not clear always up front. And then what percentage of future rounds do you follow on? So let's say you're an emerging manager and you raise $50 million for your fund, and you're going to allocate $25 million of that to initial investments and then save another $25 million of that for follow-on investments. So let's say you're writing $500,000 to $1 million check sizes. You're going to write 25 checks from that first stage of the fund, and then usually you want to reserve a certain amount of capital to continue investing in those companies as time goes on, because it's a good signal for you as an emerging manager to have follow-on, and it also gives you insight as to whether or not they actually understand what they're doing in planning their fund. If they say like, oh yeah, we follow on everything, like okay, that's not true. Like that's a lie, and that tells you something useful about them. If they say we don't follow at all, like okay, well that's also a weird structure. The answer should be like, oh, we follow on about 25% of companies as an emerging management fund, or we reserve that for like 50 or 75. They should have a specific answer to that question. All right, tier 2 institutional. These are the sort of middle market of the VC world. They've got between $100 and $500 million at the high end. Most of them will settle around like 150 to 250. These people have returned a couple of funds already. So VC funds by default, as I mentioned earlier, right, they're structured on a 10-year scale. If someone has been in the business for less than 30 years and has returned 3 or more funds, it's because they've been very successful. They've invested in companies that have subsequently raised large enough rounds that they've been able to sell their shares in secondary to pay back their LPs, or it's because those companies have gotten acquired, they've been paid, and they've paid back their LPs. The dream is to find a fund that's got like $150 million under management and has returned 3 or more funds within like a 15-year period. Like that's an investor who's being very successful. It matters to you as the founder because investors who are viewed as successful by other investors will make your life easier. Like they are respected on their position on the cap table, and tier 1 and tier 2 investors usually like to see the most successful other investors on there. Sort of a callback to the earlier slides, but one of the other problems of working with sort of the clown town of investors is that if you're trying to work with a tier 1 or a tier 2 institutional and they see a bunch of names on your cap table that are just like random people, like they don't want to have their name on there too. And so you can eliminate your ability to raise from some of the best investors in the world just because you took money from someone they think is dumb. And that's a shame. So again, you're looking for a mutual fit here, right? And because these funds are usually going to be focused on certain verticals, or there'll be a generalist fund, but generally generalist funds are kind of not worth your time. So you want to ask them what the portfolio breakdown is across verticals. Again, you've met this person at an event, they say they're working for this fund, it's got $300 million under management, you don't know anything about the fund, so you want to ask them, okay, which verticals are you invested in? They'll say, oh, defense, biotech, and health. Okay, great, that's useful. If you're in one of those 3, continue the conversation. If not, oh, I might know a founder for you. See you later. What percentage of the fund is allocated? So this matters a lot, right? And it's an important question for realistically anyone that claims they're in institutional capital, but it matters exceptionally highly for these people in the middle. Again, if they raise their fund this year, they're supposed to allocate over 5 years. If you're talking to somebody who is in year 7 of running their fund, most of their money will have already been allocated, and the remaining money that they have, they'll be saving for follow-on investments from the previous companies they've already invested in. So what that tells you again is that this is not a worthwhile conversation. Like, they're not investing in new companies after the 5th year of their fund, generally speaking, unless it's for some reason only 20% allocated. Then there's a whole other tree of why, but you can worry about that later. This just tells you quickly, oh, they say 50% or more, like, cool, move on. Lead or follow, same question as before, but very important. Percentage of future rounds do you follow in? Again, critically important for these people. All right, this is the world of tier 1 institutions. This is the Kleiner Perkins, the Andreessen Horowitz, the Benchmark Capitals, the KKRs. This is the top tier. They will have returned at least 8 funds. Usually they're in the neighborhood of like 8 to 30. Multiple funds with specific vertical focus is the current structure that's used. So within Andreessen Horowitz, it's not just all one giant pile of cash. Andreessen Horowitz has their game fund. They've got their defense fund that they call American Dynamism. They've got a software fund. They've got all these different specific things, and that plays into the way that you want to deal with these people and ask them questions. And they'll write checks all the way along. The main reason why you want to engage with these high-quality institutional investors is because if you're a company that's going to raise multiple rounds of funding over time, and you only have investors that are capable of participating in the round that you are currently in, it creates a compounding amount of work for you as time goes on, versus if you're able to bring on a high-tier institutional investor early that can act as an anchor for your future rounds, it makes your life much, much easier. Right? Like, imagine if you're trying to raise $30 million, you got to find $30 million of new people. That's much harder than calling up the person that gave you $5 million last time and asking them if they want some space. Or more likely, by virtue of the terms that you signed with them, they have pro rata rights that you don't have to ask them. They will exercise their rights to continue to invest in you. These conversations are pretty much always worth your time. They may not invest in you, but it's good to be on their radar. Percentage of the fund is allocated. Like, within the gaming fund, when did Andreessen raise that, and how much of the fund is allocated? Could be very different from the American Dynamism Fund. Could be very different from the biotech fund, right? It's important to ask these questions. Probably if you're meeting someone at an event, they're going to be an associate or a principal. These are generally not people who have investment making capabilities. The partners and the general partners are the ones who can actually write checks. And broadly speaking, the partners have to take companies to an investment committee, even at the earliest stages, and that investment committee will be anchored by the general partners of this fund. So you want to ask the question of, like, okay, associate, which partner focuses on seed stage in games or growth stage in biotech, whatever it happens to be, because they can tell you and point you that way. Otherwise, like, Andreessen Horowitz has, I think, like 150 partners now. So it can be a huge pain in the ass to figure out which person you actually want to talk to.
I'm sorry, but how would you tell somebody, basically, I don't need you, who do I need to talk to? That's what you...
Yeah, correct.
That's, how would you say that and not be off-putting?
Oh, well, that's kind of the way you ask this question gets at that. Basically, like, if you're the associate and I'm the founder, and you say, like, oh, I'm an associate at Andreessen, I might ask you, like, oh, cool, which partner focuses on seed stage biotech investing? Yeah, exactly. Instead of being like, oh, I don't care about you, you're a dumb associate. Yeah, exactly. Like, who's your boss? Like, let me talk to them, right? That usually doesn't win you too many points. And yeah, I mean, it's an especially poignant question you ask, because people who are associates at tier 1 funds usually have really big egos about it. They're going to be like a 22 to like 25-year-old who like graduated Stanford and like had a job at some prestigious consulting group and then like moved over to a VC, and they'll really think they're like really all that. So you don't want to, say anything to them that's like, yeah, you are but a lowly peon, like, because they think of themselves so highly. And people with feelings hurt don't help you, it turns out, even if you're right. So, and then the question for the tier 1 funds is, what % ownership do you target? Generally, this will be about the same across all of them, which is that if there's a tier 1 fund that's seeking to invest in you from seed through to the end, they will be seeking to grab about 30 to 40% of your company over the course of all of those rounds. Within the first round, they'll usually be targeting 10 to 15%, like the earliest pre-seed and seed rounds, and then at the Series A, it'll be another another 10 to 15%, and then you'll be in a position where they'll want a board seat, generally speaking, because if they own 25% or more of the company, that's usually where that comes into play. All right, so that's the whole world of the worst type of angels to the top of institutional investors. In my very original diagram, there was a big circle over here on the right that said CVC in it. So what is CVC? It kind of exists outside of this hierarchy, but it's called corporate venture capital. Some people call it sponsored capital, but generally it's called corporate venture capital. And what's going on here is that a large company has looked at the space that they're in, and they recognize that they're an incumbent there. They know that they've got a good space in this industry, but they know that there's a lot of startups being funded who might grow up and become a problem for them, right? Might take over some of their position. So instead of just waiting until they get acquired later on and paying the highest price for those companies, they've established venture groups within their company that seek to invest at an earlier stage. Most CVCs start at Series A. Some of them will go earlier, but by and large, they're looking for you to have product market fit, a validation for the company, revenue on the books, it's actually growing, and they can tell that you're on track to becoming a problem for them. And so that's when they want to get involved. They're tricky because they can run in one of three primary ways. The first way is that they are strategically gated, which means that there's a whole crew of people who will be an associate, a principal, a partner, etc., but none of those people can write checks until a business unit leader at that company gives the approval and says, yeah, we're actually going to use this. So let's say, for example, you make a piece of software that helps with fleet management, and you're talking to FedEx's venture group, and you want to have this on all the FedEx trucks, right? The venture people will say, wow, this sounds great. What a wonderful investment. Let's talk, let's talk, let's talk. And then once they're satisfied and they think it's a good product, they'll go to the business unit leader for fleet management within FedEx, and they'll go to that guy and say, hey, we've got this company. We think we should invest in it. It looks really good. Can you look at this and figure out a way to make a deal with this company? The problem with this is that you end up in a deal flow cycle attached to like a Fortune 500 level company, meaning that those deals are going to take months to play out. You also run into a messed up series of incentive structures on the part of the business unit leaders within those companies. So let's take again that example, the fleet management VP at FedEx. That guy has a set of metrics against which he's judged and against which his bonuses are either paid or aren't. And so if he's looking at your new company's software product and views it as a potential danger to one of his metrics if he was to adopt it and maybe not get his like $500,000 bonus at the end of the year because he used your software solution and it crashed in the middle of it, yeah, there's really no incentive for him to say, yes, we should do this. And so when you talk to a CVC and they say, like, we are a pure strategic fund that is gated by business units, know that you're in for like a 4 to 6 month long process that will most likely end in nothing because the incentive structures are not well aligned. The second structure that they'll use is pure financially motivated. So FedEx as a company says, we're taking $100 million out of our bank account, we are putting it into a FedEx venture fund, and we're just going to run it like a normal VC. You don't have to have any deals with FedEx to be invested in, we're just trying to increase our exposure in the space. They run on the same structure. They've got 5 to 10 years to return the fund. That's the goal. So it's purely financially motivated, operates basically like any other tier 2 venture fund. The third and the most intelligent and what I think, what I've seen a lot of them move to and what I expect most of them will move to in the near future is pure financial structure for early stage checks. And as you get into larger checks at the growth stage, then there is strategic alignment required, business unit head approval. So like if they're writing a $1 million check into your $3 million seed round, just the VC people have to be happy with it. If they're going to write a $30 million check into your $50 million growth round, then you have to have a deal with them and business unit approval. But that works out because by the time you're raising the $50 million round, your business cycle is longer, it aligns more effectively with their business cycle is. You're also a more mature company, so that VP who has to approve it isn't worried about losing his bonus because your software is going to crash. So that's what I expect most of them will be moving to. But yeah, these are just the questions that you want to ask, right? Like gated on BU involvement, you know, is it a financial or strategic mandate? And if it's the third one where it's broken up, that gives them the opportunity to explain that, and then you have useful information. All right, the last thing in this presentation is kind of how to approach these conversations and what they tend to care about. Because each of these different classes of people will generally be looking for and aiming for a different type of outcome. The folks in Clowntown are looking for an immediate return and no risk because they've heard about the great Uber guy and wow, oh my gosh, I use Uber all the time, so obviously this is going to happen. That is a fantasy. They don't know it's a fantasy, but it's a fantasy. And that's a big problem because they don't know it's a fantasy, so they'll keep wasting people's time asking for it. Family offices, they care about paths to profitability and how the company is going to exit. You know, if you're a company that's talking to family offices, they're not necessarily interested in companies that have like no obvious way to make money. They want you to have a straightforward way to make money and understand how that's actually going to go, because generally that family will have made their money through attachment to some type of traditional industry, like, you know, financial services or real estate or, you know, any type of thing that actually makes money in the real economy, not just purely meetup tech nonsense. The tier 3 and emerging people basically are trying to run a Ponzi scheme. What they care about is you raising your next round. That's the thing that they're optimizing for. So if you talk to a tier 3 or emerging manager about how you're going to be able to get to a state of profitability off of this fund that you're raising right now, disqualified. They do not want to talk to you. It is the opposite. You cannot talk about how you're going to make money right away. You have to talk about how you're going to generate enough additional traction and enough activity and enough growth to generate 2 or 3 more rounds of funding. Now, what your actual business ends up doing and what your plans may be, who knows, but the point is that you will be immediately disqualified from conversations with them if you talk about actually making money right away. The tier 2 people. What they're aiming for is, out of the 100 companies they invest in, to get a few that end up with $1 billion plus exit. That will put them in a position where they can return their fund, and they care about what the path is to that. That's like a good outcome, right? The tier 1s don't care about good outcomes. They want industry-defining outcomes. You have to exit as a $10 billion plus company for them to really get the return on the $1 billion that they have raised and allocated across these companies, right? And as a result, the conversation that you have with them is pretty different. And the way that they are trained to have these conversations is also pretty different. What they care about is the biggest vision possible. How big can this vision possibly get? So let's say you're launching a company and you've got like a launch product that you think is going to be really good and you think it's going to lead you to like high amounts of revenue. They don't want to hear about that product. They don't care. They care about fundamentally what space you are playing in, why it's one of the biggest spaces on earth, and why your vision extends to the massive, largest scale possible. Say you're a biotech company with like a therapy for a certain disease. If you talk about the therapy for that certain disease, they don't care. Any one disease is not going to be big enough to be billions and billions and billions of dollars. It's not going to be industry defining. What you have instead to talk about is how the gene therapy as a new category within pharmaceuticals is going to entirely redefine the entire global industry of pharmaceuticals. You dig? So even though the thing that you have may not be exactly that, you have to have this vision and be able to speak to it. And if you don't, they're not interested. So it's a completely different style of conversation. Oh, thank you. And then the last thing, CVCs, generally speaking, they care about strategic relevance. If they're operating on a pure financial mandate, they'll be a mix of the tier 3 and the tier 2, but almost all of them operate with strategic relevance in mind. So you need to be a company that they're going to want to buy later on, or they're going to have a lot of business to do with you later on. So that's the talk. Thank you. Let's see. Problem. Please, questions. Yeah, that's the other goal here, is to make the second half of this conversation.
How important do you think it is to have a firm number of how much you want to raise when you're talking to investors? A, and B, if they were to, do you think they're going to ask, how are you going to allocate that capital?
Yeah, it's critically important to know exactly how much money you're going to raise. You can't be like, oh, we're raising like, maybe like $10 to $20 million. And like, no, you have to know exactly how much money you're raising. And to the second half of your question, you have to be able to speak to what you're going to do with that money. Again, for the different tiers, there's different levels of granularity that you want to get to. Like for the earlier stage investors, you want to talk about the specific teams. For the later stage investors, you might talk about the types of things. But the point is that you need to know exactly how much money you're raising and what the purpose of that fundraising is. Because because the answers to those questions, if you don't have them, it just looks like you didn't do any homework. You didn't really think about it that hard.
And a good example for a top tier failure would be Theranos or Theranos or Elizabeth Holmes.
So yes, total failure, but interesting example. So like a lot of people look at Theranos and they're like, how could this person have raised so much money without a product and all this stuff? It's because she was very, very, very good at expressing that vision. Right? Like, we are going to solve all blood testing. It wasn't just about like the first pinprick and we get all these results out of it. It's like we are going to restructure the entire world of pharmaceutical analysis through this category of technology. She would have actually been very unsuccessful fundraising from family offices because they'd be like, how are you actually going to make money? And she'd be like, well, we're going to make these machines and do this. And like, then it would all fall apart. Other questions? Yes?
Yeah, I have a question. Why Elvis Presley?
Oh, we're in Vegas. That's it. It's just on theme. That's all. Yes.
What tier would you categorize Shark Tank investors?
I would put Shark Tank is kind of Clown Town. Kind of Clown Town. There are some people on Shark Tank who are not total Clown Town. Like Mark Cuban is kind of respected as like a real investor, and he's got good networks and connections, but broadly speaking, the rest of them are Clown Town.
Actually, I had another question.
Oh, sorry, there's a guy behind you that didn't get to ask one yet.
Yeah, what would be some proper venues to approach some of these VCs, like any of the tiers? Like, would it be online? Would it be through like different events, or how would people?
Yeah, so if you're going to approach them not in person, so okay, in-person at events is the best way to do cold outreach. If you're going to the right events and you're meeting people there, like the goal is that you go to an event, there's 100 people there, and you cover like 30 people over the course of like the 2 hours that you're at the event. That's basically what you're trying to do. You do that like 100 times, you'll find the people that you're looking for. And that's kind of like the event grind, and you want to find those events on Luma and Partiful. If you're doing direct cold outreach via email, it's like a 0.001% chance they look at it. If you're doing cold outreach via phone, same thing, 0.001% chance. If you're not going to meet them in person at an event, then what you really need to be doing is working to get an appropriate intro to them. And there's an entire sort of tier list of intros, right? So like the worst type of intro to get is an investor that's passed on you. Someone that says like, oh, we like your company, but we don't want to invest in you. But if you want, I can introduce you to these people. And they'll always offer that. And unfortunately, by and large, you have to say no, because if you're being introduced by someone who's already passed, the immediate game theory of the person you're talking to is like, well, what the fuck, why would I care, right? Like, the second is like service providers. So like lawyers or bankers who like know these people through their business. That's not a very good intro because there's no real validation that your company is a good investment through that either. Same kind of problem as the people that passed, just not quite as obviously bad. The next tier up is investors that aren't in your vertical, so you wouldn't have pitched them, but are connected to these investors. So the fact that they haven't invested is not a negative mark against you, but they're actually giving a positive mark because they're like, wow, I'm not in this vertical, but if I was, I would have invested, so let me introduce you to this guy. After that, kind of get to like the good tier of investor intros, which is founders in their portfolio. That is the single best type of introduction. Like they've already invested in you, they like your company, they think it's good, and you met me, and you're like, Will's company is the shit, absolutely talk to this guy. That's kind of at the top of the pyramid. Yes?
Is it still a negative signal to take these small checks if it's an investor that like works in your industry?
No, not necessarily. The key is that when you get asked like, who is this person, that you have a good answer. So like in the case of, just use my company as an example, we raised our pre-seed round all from family offices that own car dealerships. And normally that would be like, what the fuck, why do you have car dealerships as investors? That is our core customer type. That is our entire GTM. So when I'm talking to like a tier 1 institutional and they ask why these people are on the cap table, I'm like, because they have insanely valuable things to say and they're buying all of my products. Like, okay, great. Like they don't know who George Grubbs is, but everyone in the dealership world does, and they're like, okay, that makes sense. So yeah, you can take like a 20, 50K check from someone who has name brand value in your space, and that's helpful.
Okay. So you would say it's not to say that people who may be occupying cloud time are not useful categorically. It's that they have the biggest risk and you need to vet them the most thoroughly.
Correct, yeah. And also, I mean, another thing too is that people who operate as individual angels that have a range of check size from like, 500 down, even if their average check size is 200 and they put 50K into you, it's not necessarily a bad signal that they only gave you 50K. It's a better signal that they're on the cap table. It's their sort of like endorsement, right?
What do you do when an investor says, yeah, sounds interesting, send me a deck?
Unfortunately, that's not usually a worthwhile use of time. That usually happens on cold outreach. So you'll email them, they'll look at your name and see what you said. They'll say, that's interesting, send me a deck. You send the deck, they forward it to an associate. The associate comes up with reasons why it's not good. They say to the partner, it's not good, and that's the end of the conversation. It's pretty much always fruitless to send decks before you're talking to the decision maker. Decks are at the most a visual aid during your second or third conversation with a partner who actually can do investing. Don't send a deck in advance.
So how would you avoid sending the deck if they ask?
The conversation's already over if they asked. You already lost the game.
Do you have any advice on structuring when you initially meet someone, trying to do it in groups? Like you want to try to meet as many people first and then start going around asking for money? Like is it good to sort of meet before making the ask?
Yeah, almost always. If you can, the best way to structure it is over like a 3 to 4 month period where the first 2 months are networking as much as possible to meet people, and you're not fundraising yet, you're just describing what the company is and being a cool guy. And then once you've already had a little bit of a touch point with them, then you reach out and say, okay, we're fundraising, and ideally you're doing all of that outreach at the exact same moment. So like in the case of my company, we're raising our seed round right now. I didn't talk about that for the last 6 months. I just was networking and talking to investors, and last week we started it, so I got like 20 intros stacked up for Monday, 20 intros stacked up for Tuesday, and those conversations are all ongoing simultaneously. Another thing that matters around that timing and sort of synchronicity is that these people all talk to each other. Not necessarily all of them, but most of the people. Like if you work on Sand Hill Road, you hang out at the same bars and you talk to the same people. And so if they overhear someone else talking about your thing, that like, oh shit. All of the dumbest parts of consumer psychology, by and large, rule the fundraising world. So like stupidity around like FOMO, like, oh man, I heard so-and-so's talking about it, I better get that too. It's literally like children learning about action figures and shit. Like it's the same exact things that are going on in their brain. So unfortunately, it is in your best interest to play that game. I wish it wasn't true. It is the worst part, honestly. Ugh.
If an investor were to ask you, what type of valuation are you looking for? Should you respond? Or is it kind of like when an employer were to ask you what kind of salary you're looking for? Do you have like sort of a party line that doesn't give a number but says, I'm sure we'll come to something that is marketable or something like that?
Yeah, I mean, well, there's two parts of that. If you're raising a safe round and they ask you what the valuation is, you explain the cap that you've set for the safe round, and that'll be based off of market equivalences within your industry. So you should have a number. Like it shouldn't, unless you're, for some reason you have enough confidence to say it's an uncapped safe round, there should be a number that you set the cap at, and then you should express that, because when you're doing a safe round, investors don't set the terms, you do, and then gather that. If you're doing a priced round, then the first investor that gives you a term sheet is generally, or the first term sheet that you accept sets the sort of valuation for that round. But again, you should have a target valuation and be able to speak to why that target is this way. Like what multiple are you using to get there? Because you're doing safe rounds until the point that you have revenue, you can generally calculate what your valuation should be based on the multiples used in your space, in your stage, based on your set of growth, and at the end of the day, acknowledge that like this is the valuation that we're targeting, and then it's determined by the terms you get. Yes.
Is it typical for like cap safes that you just keep ratcheting up the cap as you raise more because the money is like less immediately useful? Or do you have like a certain amount that you're trying to raise and like the cap is the cap for everybody that's in that amount?
So safe rounds have a whole weird layer of game theory to them because they don't have the same reporting as priced rounds do. So like when you do a priced round, it's reported to the SEC. It's like information that's available online. You can find out this stuff. When you're doing safe rounds, it's not. So the answer is yes, you do keep ratcheting up the cap in the same way that you would have increasing valuations as time goes on, but there will generally be tranches, and if the broader investment community becomes aware of what those tranches are and they don't make sense, then you have a problem. So like say you raise at a $10 million cap, you raise $1 million, and then you decide that you're gonna raise at a $50 million cap, and you start doing that tomorrow and nothing is materially different about the company, and people talk about that, then you're kind of you look unprofessional, you look like you're kind of a shyster, and that's bad. So yes, the answer is that the caps go up over time, but they go up commensurately with the additional progression of your company. So like, just to use Saferide as another example, we raised pre-seed of $1 million on a $10 million cap safe last year. That's when I was a solo founder with no team and a product that was in prototype stage, and we have no revenue. Now I'm raising a $3 million seed round on a $10 million cap safe. I have a team, I have a product which is ready to ship, I have purchase orders from customers, so there are like material differences. And the purchase orders from the customers equate to a level of revenue that if one was to apply the normal multiples for our industry to them, it would equate to roughly a $30 million price round. So as a result, I can defend all of that in conversation, and there's no like, you look like a shyster kind of stuff.
Yeah, you have two parties that are sort of at odds. Your existing investors don't want new people coming in at the same cap. The new investors don't want to go in at too high of a cap, that the old investors got it much lower than that. So
Yeah, there's a funny balance in the game theory there. Well, all right. Oh, yes.
One more with that, like if you are raising with like a higher cap with a safe, but it's like 6 months down the line, is it normal to just go back to the existing investors and say like, hey, you can put more in now if you want, but like this is like the new cap for the new like section of it without it being a price round yet?
Yes and no. It depends. It depends on what the relationship is with that investor and sort of who they are. If they're, usually how it goes is that you raise from them, then you send updates, and then based on the content of the updates, and these updates are at whatever cadence you choose. I do like once every 2-3 months. And usually they'll be like, oh man, this is so exciting. And if you can tell their excitement and interest is building, then it makes sense to reach out to them and talk to them. Or that they're an individual who, is typically doing 500K check sizes, but in your last round they did 50 for whatever reason, you've got reason to go back and talk to them. There isn't that much downside in making the offer to them. Another thing too that sometimes will come is with safe rounds, sometimes people will require side letters, and side letters will define additional terms like pro rata rights. So like, for example, we took 50K from Draper University in San Francisco, the only institutional I allowed into our previous round, and they have pro rata rights. Technically, those pro rata rights only take place if I raise a priced round, but because I know that they requested this in the side letter, the spirit of it is that they want pro rata rights on future investment, so I just had a conversation with them 2 days ago about what they're going to do for this coming round.
Okay, and is what differentiates like a pre-seed or seed, like a safe round from a price round? Is it like different kinds of documents? Like what constitutes a price round?
Yeah, so priced round, okay. The labels of seed, pre-seed, Series A and all that, there's no like hard and fast, this maps to this, but there are generally accepted mappings. So broadly speaking, if anything after the seed round is a safe round, that's going to be very surprising. Series A and beyond will always be priced rounds. Sometimes the seed will be a priced round, sometimes it will not be. The different documents, absolutely. So in order to do a priced round, you have to go through a 409A evaluation process, and you have to have a financial auditing group who looks at this and gives their sign off that yes, in fact, this is worth this much money, and we're going to say that to the government. Safe rounds are literally just, I made this up and you signed the paper. So there's no requirements. To do a priced round from a like legal fees point of view is like $50,000 to $150,000 of legal fees, depending on who you get and how much you raised. Safe rounds have like no legal fees. So broadly speaking, most companies will do safe for seed and pre-seed, and then beyond that will be priced, but it's about 50-50 on the seed round, whether you do the priced or the safe. Where the seed, pre-seed, Series A, and so on names actually come into play is like what stage the company is at. And yeah, you can just say we're at this versus that, but it's like pre-seed is, you've got the vision, but you're a pre-product, definitely pre-product market fit, pre-revenue. Seed is that you've got the vision, you have the product, and you have some indication of product market fit, but it's not validated yet. And you've got leading indicators on revenue, but no revenue booked yet. And then in order to raise a Series A, you have to have product market fit validated as seen through the existence of several, like lots of customers and lots of revenue that you've already got.
Minor question is, has the whole industry moved to SAFEs at this point, or do you still see people wanting to invest on convertible notes?
I have not run into anybody that does a convertible note in the last like 6 to 8 months. But I will say that that will vary based on the space. Like each of these series of trends kind of, like each industry within investment sort of carries its own set of things. So I can kind of only speak to the industries that I've occupied. There may well be other sectors, I mean, if anyone has experience with that offhand, feel free to speak to it. But there may well be other sectors in which convertible notes are still used. All right, thank you. Thank you, everybody.